Hi, I'm Steve LaFrance with Blakely Financial, and here's a brief summary of recent market action in October 2021. The S&P 500 generated a 7% total return during October. Small caps returned 4.3% and international stocks returned 3.2%. Consumer discretionary and energy were the top performing sectors. Communication services was the worst performing sector. Investment grade bonds generated 0.5%, and high yield bonds were down 0.3%. COVID cases are declining as the Delta variant fades, but the pandemic is leaving lasting economic effects. Supply chains are strained as strong demand overwhelms reduced production capacity and stressed shipping networks. Inflation remains stubbornly high, resulting in price increases across food, clothing, appliances, and other everyday items. The price of WTI oil rose 11% as demand increased and oil production lagged. The preliminary GDP estimate indicates the economy expanded at a 2% annualized pace during the third quarter, a slowdown from the 6.3 and 6.7% recorded during the first two quarters. The current economic environment is fueling a stagflation debate. The term originated in the 70s, but was rarely used over the past decades, so it's okay if you're not familiar with what it means. Stagflation is defined as a period of high inflation, high unemployment, and slow economic growth. This talk increased in recent months as the aforementioned supply chain issues, rising energy prices, and inflation pressures led to concerns about slower economic growth. The slower growth we just experienced during Q3 merits a closer look at the data. Fortunately, the U.S. economy has not experienced many stagflation periods. While historical precedent is limited, current economic data has not deteriorated to a level consistent with stagflation. Q3 GDP growth slowed but remained positive. The Federal Reserve recently upgraded its 2022 and 23 GDP growth estimates, indicating it views the economic environment as temporary. Consumer price inflation rose 5.4% year over year during September, but recent month-over-month trends showed inflation is below the high levels experienced earlier this year. Labor market data suggests the 4.8% unemployment rate is related to lower labor force participation and voluntary quits rather than layoffs. The question is how quickly the economy can get back to normal. In our view, supply chain, inflation, and labor market pressures will ease over the next 12 months, and the market stagflation fears are overblown. While risks are still very much with us, much of the medical and economic damage appears to have peaked. Thank you for taking time to hear my update and for your trust and confidence.